Hey everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video today. This is of course a video series we started a number of months ago, and these videos are designed to add value to and complement the Undervalued Dividend Growth Stock of the Week series. And that series is a series of articles that we started years ago, whereby every Sunday I publish what looks like a compelling long-term dividend growth investment stock idea based on fundamentals, based on quality of the business, durable competitive advantages, and of course, finally, perhaps the most important aspect, the valuation. So we want to clear a number of different hurdles there. The first hurdle we clear is we make sure it's a dividend growth stock, so we make sure there's a long-standing track record of growing dividends, which are generally a good litmus test for business quality in and of itself. I mean, you can't grow dividends for 20 or 30 consecutive years without doing a lot of things right in the business. So that's the first hurdle we clear. Then we clear, of course, fundamentals and competitive advantages. So there's a quantitative and qualitative analysis on the business to make sure that it meets certain quality standards. And then finally, the third hurdle to clear is valuation. Because any business, even if you have a really great business, if you're paying significantly too much for the stock, that's really going to harm you over the long run. So we want to clear all three hurdles. And once we do, and there's a good idea there, I write about it, present an article to the investment community every Sunday, and these are basically free ideas for you guys to walk away from and take value from, and we hope that it helps you. And certainly over the last few years there have been a lot of ideas that I've written about that have done incredibly well. Some haven't. I'm not going to get them all right, but for the most part these are really fantastic long-term investments that have treated their shareholders correctly over the long run. So getting into today's video, of course, just backing up for a moment, if you're unfamiliar with this video series, or if you're unfamiliar with the Undervalued Dividend Growth Stock of the Week article series, if you're at dailytradealert.com, you go to the dividend growth investing heading there, the third one in on up top there, and then you click on the Undervalued Dividend Growth Stock of the Week tab, and that'll bring you to the entire archive of Undervalued Dividend Growth Stock of the Week articles stretching back to 2014, and you can kind of see some of the businesses we talk about. We talk about Nike, Walt Disney, VF Corp, Target, Medtronic is in there, Qualcomm. So there's a lot of well-known global businesses that are selling products and or services to people all over the world. They're doing really well with that. Generally their profit, the revenue, the top line and bottom line is growing over the long run, which allows them to feed those bigger dividends into the pockets of the shareholders. So getting into today's article and getting into today's video, the article I selected for this video, and again, this video series is designed to kind of go over a recent article. So we're highlighting the article, we're breaking everything down so that you guys can see if you're reading the article and you're thinking, where did this come from, or what's he talking about here, or where's this idea at? These videos talk about all of that in real time, okay? So the article I selected for today's video is Amgen, which I've already clicked on, but if you click on that, it'll bring the actual article up. And I'm going to scroll up to the top here because I was just kind of reading through it before I started the video. So this was the most recent Undervalued Dividend Growth Stock of the Week article as I'm shooting this video on the 7th of December. By the time this video goes live, there may be another article or two published, so just keep that in mind. But as of right now, this article was published on December 3rd, 2017. And I selected Amgen for today's video for a lot of the same reasons I selected it for the article. It's a really wonderful business in the biotech and the pharmaceutical space. It just really is firing on all cylinders. It offers a lot to like, and the valuation's pretty appealing. And it's a pretty strong business to highlight for the investor community. And I'm a shareholder in the business as well. So as I've talked about in prior videos, I don't just talk the talk, I walk the walk. I invest my own hard-earned capital in these businesses, and I've personally experienced so much success, so many life-changing benefits from dividend growth investing, from living below my means, from investing my excess capital in these businesses. And it's allowed me financial independence in my early 30s, which has been a life-changing paradigm shift in terms of how I approach life, how I think about my time, how I think about my money, what I'm able to do, what I'm able to accomplish, how I'm able to grow as a person. And so these are tremendous benefits that I feel almost obligated to share with you guys. I feel like I'd be remiss if I didn't talk about this stuff regularly to help people, to motivate people, to inspire people, because I feel like I'm kind of attending this really amazing party, but there's probably only a few people out there attending it, and I'm saying, come on, let's all join in on the fun, right? So getting into today's article, as I've spoken about in the prior videos, every Undervalued Dividend Growth Stock of the Week article starts out with what I call a big idea. It's kind of a buy-in for you readers. It's kind of my way of drawing you into why you should even be interested in not only the article that you're reading, but this investment strategy, this holistic lifestyle in general. I mean, what's in it for you? How can this change your life? How can it benefit you? What's the point of all of this, right? So talking about this article today, the first sentence here, I'll kind of read over what I wrote. Occam's razor is a problem-solving principle that states that among competing hypotheses, the one with the fewest assumptions should be chosen. This principle is usually boiled down into the following: the simplest answer is often the right answer. And talking a little bit about Occam's razor, I kind of use that as a segue or kind of an analogy into sometimes there's a mindset I encounter when I reach out to people, or when people ask me that they find out kind of what I'm doing, they find out I'm financially independent, and they think that I must have that if I didn't win the lottery, that my investment strategy, however I got here, must be this extremely complicated method, that I must have some kind of inside track on them, that I must be doing some kind of crazy stuff that they've never heard of. And so I kind of talk about it here when people ask me what I'm doing. When they hear about my investment strategy, they're puzzled. They're often puzzled. They almost immediately counter with any number of better investment ideas: cryptocurrency, tech startups, angel investing, penny stocks, or a friend's really good business that just needs a little capital, right? My friend has a great business. You should invest in it. It's a good opportunity for you. And why isn't it a good opportunity for you and your friend, right? So, and I say, are these investment ideas necessarily better? No, but they're a lot more complicated, and they're also generally a lot riskier as well. And that's the thing about dividend growth investing. It's simple. It's very simple to understand, very simple to execute, but simultaneously, it can also be incredibly successful for you. So I think people sometimes believe there's a parallel between success and complication, such as that the more uncomplicated something is, the more unsuccessful you will be with it, and likewise, vice versa, the more complicated something is, the more successful you will then be. And that's actually the opposite of how things work in life, especially with investing. The more complicated, the more risky an investment style is. If you get into something you can barely understand what it is somebody's talking about, that's a good sign to run away, to run in the opposite direction. That's not a good idea, like, oh my gosh, I can't understand this must be gold. Yet, for some reason, I don't know if it's part of the human condition, I don't know what it is, but for some people do these mental gymnastics in their mind, and they talk themselves into that because I maybe don't understand this well, or this must somehow be good because it sounds really complicated. And that's just not really the case at all. Dividend growth investing is a super straightforward investment strategy, yet I personally, and I know of people that have also done this, but I personally used it to go from below broke to financial independence in a very short period of time. So if it is simple, that there's I don't think anybody can argue that dividend growth investing is a particularly complicated strategy, so we can agree on that. And then we can also agree that it can lead to tremendous success because I personally experienced it. So, I have proof on kind of both sides of the coin there. So I just want to talk a little bit about that, and I also made a note here. If you don't believe me, just look at how Warren Buffett, the world's most successful investor of all time, invests. Buffett invests Berkshire Hathaway capital, which i.e. another way of saying it is his own money. He invests that capital into many of these same companies that I talk about. So when I talk about a Coca-Cola, when I talk about a Visa, when I talk about a business that has a demonstrated long-term track record for paying their shareholders increasing dividends for many years, because they're able to do that because they're running a good business. These businesses aren't reserved for unsuccessful investors or like widow and orphan stock or something like that. Warren Buffett himself is investing in these same stocks. So if you think, oh well, it's super simple, so it can't be possibly successful. Well, I don't know. Warren Buffett's done pretty well with it, so certainly much better than me. So if you think that I'm small potatoes and this Jason guy doesn't know what he's talking about, take a look at Warren Buffett, and maybe that'll be a little better proof for you, okay? But at the same time, we still need to make sure that we're picking the right businesses at the right valuation. It's not a thing where just picking random dividend growth stocks at random prices and that's just the way to go. That's not really what I'm saying at all. I'm saying dividend growth investing as a strategy within a holistic lifestyle that's designed to prioritize time over money and experiences over stuff. That's a wonderful aspect of that lifestyle, but within that aspect, you can't just go and blindly approach it without any kind of thought process or any kind of methodology. So the methodology, of course, here is, as I spoke about earlier, making sure you clear those hurdles, making sure first it's a dividend growth stock. That's just the first hurdle. It's not just, it's a dividend growth stock, I buy it. That's not the case. That's just the first hurdle. The second hurdle is then making sure that the fundamentals are there, because a business could have 10 or 15 years of dividend growth, and it could have been very well run for 10 or 15 years. That's certainly the case, but then maybe something happened over the last couple of years, and maybe it's not quite the same business it was. Maybe the dividend isn't quite as safe as it once was. So there's a lot of things that business changes every single day. So to say that, they have 20 years of dividend growth, so I'm just going to buy it. Okay, second hurdle you got to clear is you're making sure that you want to do a qualitative and quantitative analysis on that business. Then the third hurdle, of course, is the valuation, which is what these articles kind of highlight, and we take a great deal of time to talk about that. So, and getting into why we want to get into why we want to invest in an undervalued, high quality dividend growth stock. The reasons are actually pretty clear and pretty compelling. An undervalued dividend growth stock should present a higher yield, greater long-term total return potential, and less risk. And this is all relative to what the same stock might otherwise offer if it were fairly valued or overvalued. And how that works is, first of all, with the higher yield. When we talk about higher yield, all else equal, a lower price will result in a higher yield, because price and yield are inversely correlated. So if you have a stock that's fairly valued at $50, and the stock over the course of many months moves from 40 to 60, when it's down at 40, that yield is going to be higher, all else equal. And when it goes up to 60, above fair value, the yield is going to be much lower, all else equal, unless something happens with the dividend. Maybe the company changes the dividend payout or something like that. But that doesn't happen too often. So most likely what you're going to be looking at is you're going to be looking at a dynamic where the lower the price, the higher the yield. That's usually the dynamic that's playing out. So the lower the price you can get in at, and the further under fair value you can be, the higher the yield you're probably going to lock in as a result. And that locks in not only current income, your current yield that you're looking at in terms of how much income you're going to be producing just with the next dividend payout over the next few weeks or month, or whenever that next dividend payout comes into your pocket, into your brokerage account. That's current income you're looking at locking in at a higher rate, but it's also ongoing long-term aggregate income that could be dramatically affected by where you come in at when you initially make that investment. So, if you're, again, using that same example, if the stock is fairly valued at 50 and you're looking, and it's oscillating there all the time as businesses change, as stock prices change and everything else, well, getting that stock well below 50 versus well over 50, that's going to affect the amount of total aggregate income you collect over, if you hold it for many decades and the company continues to do well and grows dividends, that's going to affect the amount of total aggregate income you're going to collect by a significant margin, because you're locking in a much, if you're able to get it in when it's undervalued and get it well below that $50 mark and raise your yield as a result. Sure, you're looking at that higher current yield, but that long-term aggregate income is compounding. If you reinvest in that dividend, or whatever it is, all those dividend raises that company announces from there on out, here thereafter, are all based off of that yield that you locked in when you made that investment. So a 7% dividend increase on a 3% yield is certainly much greater than a 7% increase on a 2.5% yield, and so on and so forth. So that makes a major difference in terms of how much current income you're collecting, and then the aggregate income as well. And that also impacts long-term total return potential, because yield is one of two components of total return, with the other component, of course, being capital gain. But with the yield component, if you're locking in a higher yield right off the bat, then your total return right away is given that potential boost just via the higher yield. And then when talking about capital gain, you're also looking at a potential boost via the what we call the upside that exists between the lower price and the higher valuation. So again, if you have a stock fairly valued at 50 and you're able to buy it at, let's say, 40, you have $10 per share worth of potential upside that could manifest itself, that could be realized if and or when the market realizes the fair value of that stock, or potentially overshoots it and goes over fair value. This happens all the time in the market, where a stock is mispriced somewhat significantly over the short term, and then over the course of months, it just kind of returns back to where it was. So you got to use those short-term opportunities that short-term volatility is a long-term opportunity. So when you see a stock that, looks like it's worth 50, it was priced at 60, now it's at 40, that shouldn't be a sign like, oh my gosh, it was 60, now it's 40, this is terrible, this is the end of the world. You should be looking at that like, wow, this is an excellent opportunity. Before it was too expensive, now it's really cheap. This is my opportunity to get in now. So assuming all else equal, again, assuming the business isn't cratering or something. But so yeah, when you're looking at that dynamic there, that higher yield impacts the total return right off the bat, but also the long-term capital gain could also be positively impacted via that upside that exists between price and value, because the market isn't, frankly, very good at discerning fair value over the short term. Over the course of months, or even over the course really of a few years, price and value can be wildly mismatched. But over the long run, they do tend to roughly track one another. I mean, if fair value of a business kind of looks like this as it just becomes more successful, just kind of maybe a steady line, price might kind of look like this kind of thing. So over the long term, you could probably draw a line and say, yeah, the market's roughly pretty good, but there's going to be a lot of moments there in between. And again, if you're looking at a long-term line, these little oscillations are potentially years of a time frame, right? So you can say, oh yeah, it's pretty good, over the long term, but this year it wasn't great, this year it wasn't great, so you got to kind of keep that in mind when you're looking at things through a longer term lens or perspective, okay? And of course, the last point is it reduces risk, and this should be fairly obvious. I mean, if you're paying far more than something is worth, then you're risking excess capital that you shouldn't be. You're limiting the yield. You're limiting the total return potential, and frankly, you might even be putting more capital on the line than you otherwise should have or could have. So that one should be pretty self-explanatory there. So getting into today's article, getting into today's stock, getting into Amgen, and just want to make a quick note. In every article, I kind of link a few things out, okay, guys? The first one is David Fish's Dividend Champions, Contenders, and Challengers list. That's where all the articles for these are, that's where all the stocks for these articles, this Undervalued Dividend Growth Stock of the Week article series that we've been running since 2014, every stock is sourced from David Fish's Dividend Champions, Contenders, and Challengers list. So when I spoke about the first hurdle to make sure it's a dividend growth stock, well, Mr. Fish, bless him, he maintains this list of over 800 different U.S. listed stocks that have paid increasing dividends to their shareholders for at least the last 5 consecutive years. So when kind of calling down the universe of all thousands or so of available publicly traded stocks out there, you're kind of narrowing down to just those that are paying an increasing dividend. So right away, that's clearing that first hurdle by limiting the universe of stocks for these articles to just that list. Okay, guys? I, of course, listed my own personal dividend growth stock portfolio. So when I claim that I'm financially independent, you can see exactly what that looks like, exactly what business I'm investing in, exactly how much income I'm producing, and everything else, okay? And then Warren Buffett here, the link here goes to Berkshire Hathaway's publicly, their investment stock portfolio, essentially. And then finally, I link to fellow contributor Dave Van Knap's series of lessons on dividend growth investing. He wrote a lengthy and very robust series of lessons which serve as almost like an online ebook, basically, to educate someone, be you a novice investor, an experienced investor, on how dividend growth investing works, how to implement it in real time, how to make it successful for you. And one particular lesson is a lesson on valuation, and I link to that here because I think some people might read these articles and think, okay, well, yeah, I get it, undervaluation is great, but it must be incredibly difficult to actually value a stock, because if it were easy, then everybody would be buying undervalued stocks. And again, kind of getting back to Occam's razor earlier, that's actually maybe not the case at all. If anything, people are looking at the more expensive stocks, thinking that's the way to go. So it's actually not that complicated of a process, and Dave Van Knapp, one of his lessons focuses and concentrates just on valuation, which it's a great thing to read through and should help you maybe solidify your own methodology over there. But getting into today's stock, of course, is Amgen. Market cap of over $120 billion, one of the world's largest and most successful healthcare firms in general, just in healthcare in general, but they're tremendous, just a huge company when it comes to biotechnology firms specifically. So healthcare in general, okay, but when we're talking about just biotech companies, Amgen is massive. And if the simplest answer is often the right answer, of course, getting back to Occam's razor, it makes sense to focus on investment themes that are simple and highly likely to transpire, especially over the long run. And there are few themes that are simpler and more likely to transpire than the world growing older, richer, and bigger. Because that's been playing out for a long time, continues to play out every single day. The world is where more and more people are walking this planet. Our life expectancy across the globe on average is increasing, expanding. So we're growing older as we expand our population, and of course the amount of wealth that's in the world is every single generation that comes into existence in this world, every 20 or 30 years or so, the total aggregate wealth of the world expands considerably. So the world is growing older, richer, and bigger simultaneously. And as that happens, as that theme continues to play out, which it's almost 100% sure that it's going to, the demand for access to high quality medications in order to save, prolong, or better one's life, of course, getting back to why we're growing older in the first place, that demand is only likely to grow too. So, and that bodes well for firms like Amgen, and because they have a number of branded and sought after drugs, pharmaceutical products that do just that. So it's a little beyond the scope of today's article to get into their entire drug portfolio and all of the compounds and phase 3 trials. But if you go to Amgen's investor relations site, you can actually, they have a number of investor presentations and they go through all of their different drugs, everything that's going on, and they continually release news on their pipeline of drugs, what's going on, what's approved, what's happening, and so on and so forth. A little beyond the scope of today's article, which is basically just to kind of highlight what we're talking about with today's article, what we're talking about with the dividend and the valuation and where some of the numbers came from. But they have a very robust portfolio of both current drugs that are being manufactured, being sold for billions of dollars, and then also the pipeline that's designed to keep the company going for many years to come. Okay, so getting into the dividend, of course, that's one of the first areas we talk about whenever we get into a company is the dividend. And I use, again, David Fish's Dividend Champions, Contenders, and Challengers list for that information. So we're going to scroll down to Amgen's information here real quick. If it will scroll, there it goes. So we've got Amgen pulled up here. So the first thing I note is that they've got 7 consecutive years of dividend increases. And you can see on David Fish's list, we've got consecutive years of dividend growth right here at 7 years. And then we've got the, and what I talk about next is that I think they're positioned well to continue growing that dividend for many, many more years to come. And one of the reasons why is that the payout ratio right now is just 41.6%. So I think David Fish actually lists the payout ratio. He has it at 41.55%. It's essentially the current dividend divided by trailing 12 months earnings. So we've got on Morningstar.com, we've got trailing 12-month earnings at 1107. Let's just do a quick calculation and see where we're at on that dividend payout ratio, so you can see where I'm getting the numbers from, guys. So we got 1107 on TTM EPS, okay? And then the current dividend is $1.05. I'm waiting for Morningstar to load, but I already know their dividend. But we're just gonna, I'm letting it load just so you can see where I'm getting these numbers from and everything. But of course, for Amgen's dividend, you can find it on any third-party stock site, or more preferably, you would go to their investor relations site, which I already have for the purposes of the article and the video. But yeah, I'm sorry, $1.05. I was wrong. So I'm sitting here getting ahead of myself, and I was wrong by 10 cents. So yeah, it's $1.15 a quarter. So we got $1.15 a quarter. So we got 460. Whoop. And then we're going to divide that by trailing 12 months earnings per share. And we got it 1107. So we've got a payout ratio of we'll call it 41.6% or so, which I've listed right here. And you can see where I got that number from. So I got a little ahead of myself, $1.05. I don't know where I got that from. It's $1.15. But so you got $1.15 quarterly dividend multiplied by 4. That's the annual dividend. And then you basically divide that by trailing 12 months earnings. So the payout ratio, at least the way I use it, I don't know if anybody else does it maybe slightly differently, but the payout ratio as I use it is basically kind of using a forward-looking dividend, because that's what they're expected to pay out moving forward against trailing 12 months earnings. So, there might be a little bit of a, maybe that isn't quite 100% correct the way to look at it, because I guess you'd almost want to say, well, trailing 12 months earnings against trailing 12 months dividend maybe would be more correct. Although really, for the purposes of what we're talking about, Amgen's due for a dividend increase here very shortly anyway. So the dividend as it is $1.15 is what they've been paying over the last 4 quarters anyway. So for what we're talking about today, this is pretty accurate. But sometimes if a company just announced a dividend increase and you're saying, okay, well, this is the dividend times 4 looking forward, and then you're comparing that against trailing 12 months earnings, then there's a little bit of maybe a discrepancy there, but I wouldn't really worry too much about it, but just something to kind of note there. And then next thing, so yeah, the payout ratio, we're talking 41.6%, which is still very, very modest. That leaves plenty of room for expansion of that, although we can see Amgen's payout ratio, because they've only been growing their dividend for 7 years, we can see how it's already expanded. It was, under 7% in 2011, 26, 28, 36, and it's kind of jumped up as a result. So what that tells us is that the company's been very aggressively growing its dividend, certainly much faster than earnings, because the payout ratio has just been shooting through the moon. So that would mean that what they've been growing their dividend at thus far would obviously not be the kind of expectation you'd want to build going forward, okay? And getting into that, the 5-year dividend growth rate stands at 48.2%, which is just monstrous. And where you get that, you see that right here, 5-year, 48.2%, okay? And that's just huge. That's one of the highest 5-year growth rates I've run across, certainly, across all my years of investing. You don't often see something higher than that. I mean, 50, 60% or something over 5 years. It's just really incredible, because what has to happen is 2 things have to happen simultaneously for you to get that much dividend growth over a 5-year stretch. First of all, you have to start out with almost nothing in terms of your payout ratio. You have to start out with a dividend that's maybe just freshly starting, or in Amgen's case, 7 consecutive years. So the dividend was just a couple of years into its growth when we're looking back at 5 years. So the payout ratio is very low, and then also the company's simultaneously growing at a very strong rate anyway. So they're growing the dividend at a humongous rate, but the payout ratio still is being kind of moderated somewhat by the earnings per share that are constantly expanding as well. So here I note, it's not going to continue indefinitely, guys. You'd expect some dividend growth deceleration here, and we're going to see what that looks like right now. The most recent dividend increase right here was 15%. And even that, though, I mean, if you're looking at it against 48.2%, yeah, it's disappointing, I guess. But if you're looking at it under any other circumstances, a 15% dividend increase year over year is massive and very impressive, and certainly a lot better than I ever got at a day job. Never did I walk to my boss's office and say, yeah, here, 15%, 15%, 15%, 15% year in and year out. That just doesn't really happen. So if Amgen is just busting out 15% double-digit dividend increases for the foreseeable future, there's not much to really dislike about that. Are they going to do that? Are they continue with 15% dividend increases for the long term? No. For the next few years, though, I think Amgen could continue to deliver some pretty solid dividend increases, as we'll talk about throughout the rest of the video. So the last point we make about the dividend, of course, is the yield, and Amgen's yield, where we're going to get that. I used to use Google Finance in these videos, guys, so you'll notice that the Google Finance tab is missing. I just want to make a note about that and why I'm using Morningstar for some of these numbers that I would usually use Google Finance for. Google Finance recently updated their finance. It's now like a tab under search, and I don't find it to be quite as user-friendly or robust or really anything. I find it to be really poor compared to how it was before. So I'm just kind of scrapping it for these videos and really for when I'm doing analysis and looking at things. Getting yield, I'm just actually going to do these numbers myself, and you'll kind of see where they're coming from anyway. So we've got a quarterly dividend at $1.15, right, guys, which that's set to increase here pretty shortly. So when you're looking at buying Amgen right now and you're looking at these dividend numbers and the yield and the payout ratio and everything else, these numbers are set to change here over the course of the next few months. So we're going to be looking at probably a dividend that's maybe 10% or so higher than it sits today within the next few months. But that quarterly dividend's $4.60 divided by the share price, which is currently at $176.22. So the yield at 2.61% right now. It was at 2.7 when I wrote the article. So what that tells you is, as I spoke about earlier with that yield and price dynamic, with the yield being higher when I wrote the article, that means the price was lower. Okay, so the price has jumped up a little bit since I published this article. So it was a slightly better opportunity when the article was published versus when I'm now doing this video. But obviously you didn't have to wait for the video to look at Amgen or invest in Amgen. The article was already published, and it was just a slightly better idea. And there's nothing to say that Amgen won't go down from here, or won't go down below the price that it was when I wrote the article, making it an even better opportunity. There's certainly nothing to say that that's not going to happen. So keep that in mind that, prices are changing every day. But looking at that yield, first of all, it's pretty attractive in absolute terms just because interest rates are so low right now. So getting yield of near 3% in general is not super easy like it was maybe 10 years ago. So that's the first thing to keep in mind. But in relative terms, I'm going to show you kind of what that yield looks like against some of the more recent historical numbers for the stock. So it's certainly much higher than the broader market, I can tell you that, because the S&P 500 is yielding somewhere around 2%, which you can see right here, the dividend yield. So the current dividend yield of Amgen is coming in at near 2.6, right? We're at 2.61 right here. And the 5-year average yield for the stock was only 1.9%. Now, keep in mind, though, that when I wrote this article, I noted that it's 80 basis points higher than the stock's own 5-year average. And right here, I note this. Although we do have to consider that the stock's dividend was zero as recently as early 2011. So when we're looking at this 5-year average, keep in mind that that dividend payout was growing so aggressively as Amgen continued to pump out bigger and bigger dividend increases that that 5-year average is maybe not as valuable as it would be to look at, say, like a Johnson & Johnson or something that's 50 plus years into its dividend growth cycle. Looking at 5 years of Amgen's history on a 7-year dividend growth streak is, there's not a lot of meat and potatoes there. That said, though, it certainly is much more compelling from an income standpoint than it was on average over the last 5 years. No doubt about that. So, a little bit of a caveat there, but at the same time, I think that if you were looking at Amgen as a dividend growth investor or as an income investor or somebody looking for your fair share of the profit that the company is generating, right? It's much more attractive today than it usually has been, really, since it started paying a dividend. So this is about as good as it's been since it started paying a dividend at all. So it's something really noteworthy. So, and just kind of also to put that yield in perspective in another way, we're getting a yield coming up on 3% when I wrote this article. It's dropped a little bit since then because of the prices advanced. But to get a yield near 3%, along with the potential for double-digit dividend growth for at least the next few years, that's a lot to like there, guys. I mean, if you're saying, okay, this stock is yielding almost 3%, okay, not bad. That's certainly well in excess of the broader market. A lot of fixed income isn't even offering that much yield. You're certainly not going to get it down at the bank. So, in today's world, near 3% yield, not bad. And then you also tell me, whisper in my ear, oh, also, that amount's probably going to grow double digits for at least the next few years and potentially beyond. Now my interest is really piqued, right? Because it's not just a static dividend. It's not just almost 2.6 or 2.7% ching, 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 ching year in and year out. It's not like that. It's 2.6, 2.7 today. And then if that dividend increases by, say 10% or so within the next few months, that grows to almost 3%, ching, almost 3.3%, ching, so on and so forth. So that dividend amount that you're looking at, that you're locking in today is the only thing you're locking in is the yield that it was when you bought the stock, right? But as I spoke about earlier, with the higher yield, the greater long-term total return potential, that could affect the long-term aggregate income of your investment over the very long run because that dividend growth, because those raises, those 7, 10, 15, whatever percent raises are based off of whatever it was, whatever the numbers were when you actually bought the stock. So it's something to keep in mind there, guys. Getting into building those expectations, though, for dividend growth moving forward, when I think about building expectations for dividend growth, because when we buy stock, we're not buying where the company was over the last 5 or 10 or 20 years, right? We're buying a business for where it likely will be or where we think it might go over the next 10 or 20 or 30 years. So we don't invest in where a business has been, we invest in where a business is likely going or where we think it's going. But in order to start building an expectation, we really first need to look at where a company's already been. I mean, the first place to look at in terms of starting to build an expectation, okay, well, I want to think about where Amgen is going to kind of, what kind of growth I might expect moving out over the next 5 or 10 or 15 years. Well, the best place to start building that expectation is where it's already been over the long haul, using the last 10 years as a proxy. So getting into that, revenue, we're going to look at the top line revenue growth first. And I've got two annual reports pulled up. I've got the 2007 annual report pulled up for Amgen, which you can find on the investor relations website for Amgen. And I've got the 2016 annual report pulled up here. So we can kind of look at total revenue growth right here. So we've got We've got 2007 total revenue at 14.8 billion, 14,771, which I note right here. You can see where that number came from, right, guys? And then I've got 22.991 billion for fiscal year 2016, which you can see right here. So we've got 14,771, and I'm going to use the compound annual growth rate calculator for Investopedia, but you can use whichever one that you'd prefer if you don't want to use that one. They all work the same. And we got 22,991. Whoop. And we're looking at 9 compounding periods because the first period, the starting year that we're looking at, which is 2007, that's not a growth year, that's a starting year. You didn't grow from 2007 to 2007. 2007 is just where you start. 2007 to 2008 was the first year of actual growth. So you're starting from 2008 on. So it's 9 compounding periods, okay? And that's a compound annual growth rate of 5.04% for revenue, which I've got noted right here, guys. You can see that here, which is pretty solid. I mean, as I've talked about in, I think, every video now and in numerous articles, that's about what I'd expect for a mature business for top line growth. Mid-single digit growth for a mature business is right in line with my expectations for what I've seen over the number of years that I've been investing, what I've seen for a lot of mature businesses. That's a really good number to shoot for. And Amgen is right there. So just a really good number. I mean, not extremely impressive to where I'm, jumping out of my seat, but also not disappointing at all. It's just right in line with what I think they can do. And then the next thing we're going to get into is the bottom line growth, so earnings per share growth. And you can see right here, you can see I listed the 2 numbers here, and we'll see where we got them from. So I got the 2007 annual report pulled up. Earnings per share diluted, we've got 282. You can see right here, 282, and we got 1024, and I'll show you where that came from. We got earnings per share diluted, 1024 right here. Okay. So we're gonna put that into a compound annual growth rate calculator to figure out what the compound annual growth rate has been for earnings per share. So we got 282 and 1024, and 9 compounding periods. That obviously does not change. And we've got a compound annual growth rate of 15.41% for the bottom line. I'm gonna click off that calculator now that we've used it. So 15.41%, which is just massive. I mean, especially for a mature company like this to grow its earnings per share at 15%. And getting back to my point earlier that I made about the dividend growth and kind of how monstrous that's been and how the payout ratio is still somewhat moderate considering that they've been growing the dividend at such a high rate. That's because the dividend's been growing at a very, very high rate, yes, but the company's also been growing at a very aggressive, very impressive rate too. So Amgen's been, obviously they can't continue on with 48% dividend growth, and the most recent dividend increase, frankly, of 15% is right in line with what the company's growing at. And so if they continue anywhere near this rate moving forward, based on where the payout ratio is at, they could even expand it a little bit. There's no reason why they couldn't continue to deliver low double-digit dividend growth, or at the very least high single-digit dividend growth, somewhere 8, 9, 10%. That would probably be on the low end for what I'd expect for Amgen looking out over the foreseeable future, at least over the next few years or so. But frankly, with the payout ratio being where it's at, Amgen's MO and what they're doing, their wherewithal, and looking at the whole picture, gosh, I would be surprised if that next dividend increase, and we'll see kind of what transpires because I'm putting myself on the record here, but I would be surprised if their next dividend increase is less than 10%. But we do see a discrepancy here, right, between bottom line and top line growth, and a lot of that is due to Amgen's share buybacks, which we'll kind of see what that looks like right now. We'll kind of show you how substantial that's been, which it's been significant, and this is also helping them propel or perpetuate some of that outstanding dividend growth, because whenever they're buying back shares and simultaneously increasing the dividend, well, if you're increasing the amount of your dividend paid to every single share, but there are less shares outstanding, then the actual amount of money you're spending, the actual increase in the amount of money you're spending isn't quite the same. So if you announce a dividend increase at 10%, well, but you reduce the outstanding share count at the same exact time, then you're not actually spending 10% more money. It would depend on what percentage of outstanding shares you bought back over that same period of time. Okay, so if you say, well, I'm going to pay out a 10% larger dividend, but I'm going to recall 10% of my shares, then the numbers pretty much level out, right? So let's see here. So we'll see how the share buybacks have kind of worked out for the company right now. So we've got, in 2007, we've got 1.123 billion shares. And then the most recent fiscal year, we've got 754 million shares right here for 2016. And divide that by the starting point. So we've got a reduction in the outstanding share count by almost 33%, which is not just significant in absolute terms again, but also in relative terms for a company this big and for a company this mature to be reducing its outstanding share count by 33%. I mean, I've seen some smaller businesses do some really aggressive things, some smaller cap companies, but for Amgen, this humongous company, to just be reducing its outstanding share count by a third of the company, essentially what you can buy into the company, a third of its shares, a third of the market cap it's gone over the last decade. So that's pretty significant. Moving forward, I of course in every article I talk about, so getting back to an earlier point I just made, when we start building out that expectation for future dividend growth, we start building out an expectation for future business growth, for future earnings growth. The first place we do want to look at is what they've done over the past, and again using the last 10 years as a proxy for the long haul. That's the first place you want to kind of start to build a foundation on. So you say, okay, well I want to build a house of expectations, but the foundation of that expectation, that house of expectations, should be what the company's already done over the long haul. So if a company has grown, if a company's been growing at 1% annually over the last 10 years, then for you to build a house on a foundation and say, well, this house of expectations, I think they're going to grow at 15% all of a sudden. Well, that really doesn't make a lot of sense unless something's really radically changed with the business. To go from 1 to 15 doesn't really make any sense, right? So you want to start with where they've already been, and then start to kind of shape in some more recent numbers, some press releases, start to look at the business, what are they doing, what's going on, and one professional firm that kind of starts to put all that stuff together for you is CFRA, and I'm going to show you what they've got here as I do in all the videos and as I do in all the articles. They have a number which is a 3-year projected earnings per share compound annual growth rate. You can see at the top right here, and they've got that number at 7%. So what this is here, guys, is basically CFRA here, the professional analysis firm, which used to be S&P Global. They believe that Amgen is going to compound its earnings at a 7% annual rate over the next 3 years. And I note here, this would be a notable drop from what Amgen has produced over the last decade. So what Amgen has demonstrated over the last 10 years is significantly in excess of what this is. And CFRA believes that slowing growth from mature drugs will offset much of the growth potential from newer drugs coming to market. So they're saying that those two are kind of match out roughly. So nonetheless, that's a pretty significant drop, pretty conservative in my opinion from what Amgen's been doing, even just very recently. But if we say, okay, well, they've been at 15% over the last decade. CFRA is saying they're going to drop significantly over the next 3 years down to 7. Even if they come out somewhere in the middle here, and we peg that at somewhere around 10%, that would provide for dividend growth potential at least in the same range, for at least like dividend growth based on the moderate payout ratio, guys. And that's why I said a few moments ago, I would be surprised if Amgen increases its dividend at less than 10%, somewhere between 9.5% and 10.5% would be pretty reasonable for Amgen's next dividend increase. I would be surprised if it's substantially higher than that, but for it to be much lower than that, I would also be a bit surprised. And I think, going forward, if we start to build an expectation, we say, okay, well, they've grown at 15% over the last 10 years. That's a pretty long period of time, especially considering that the last 10 years has been brutal for a lot of businesses. We had the Great Recession, the financial crisis and everything in there, a lot of political upheaval and everything, and Amgen's just 15%, 15%, 15%. So for that to kind of all of a sudden, 7% would be almost like wheels falling off the wagon here. I think that's a little conservative, but if we kind of say, okay, well, 7% sounds awfully conservative, 15% maybe also not where they're going to be based on just them being a much larger company today than they were 10 years ago, and we put that somewhere in the middle. Again, I think that would allow for dividend growth somewhere in that same range. And that all said, though, right here I also know Amgen could come in closer to that 7% over the next few years. They could come into the 7% mark over the next few years, or even beyond that period, and still provide for dividend growth somewhere near double digits for years to come, simply by virtue of where the payout ratio is at. Meaning, said another way, I'm saying right here that the payout ratio could expand a little bit and the company would be just fine. So even if they grow at 7%, so let's say 7% next year, 7% next year, 7% the next year, 7% the year after that, they could still grow the dividend at high single digits, low double digits, really without expanding the payout ratio all that much. So again, building that expectation moving forward, I would be surprised if the next dividend increase, and frankly, the foreseeable future, I would be surprised if Amgen delivers below 10% dividend growth. And 1 year could be off. Maybe next year, the year after, it's a 7 or 8% dividend increase, and then maybe the following year it's 12 or something. These aren't always uniform numbers. So when I say this kind of stuff, when I build these expectations, I'm not saying that uniformly, year in and year out, Amgen is going to produce, X dividend growth. I'm not, and when I build the dividend discount model analysis, it's averaged out. So, and there's also usually a flattening out too over the very long run. So if you're saying a company's going to grow its dividend 7% over the very long run, well, that could look like 10, 11, 12, 13%, for the next few years, and drop maybe down to 10, 11, then maybe drop down to 9, 10, and then maybe kind of flatten out a little bit over the very long term. So, and these numbers also could jump up and down a little bit too. So when I'm putting these numbers out there, I'm not saying that, you should expect, in the next, actually in the very short future here, Amgen to announce a 10% dividend increase, and then next year 9.9%, and then the following year 9.8 as it just starts to slow. I mean, it's not really how business works, guys. But when I'm saying these numbers, I'm saying that long-term averaging out, and when I'm saying 10%, I'm saying at least for the foreseeable future, I think that they could deliver on that. And then we'll look at the very long term when I go into the dividend discount model analysis here shortly. Getting into the other fundamentals of Amgen, the first thing we're going to look at here is the balance sheet, long-term debt to equity ratio, and the interest coverage ratio. So we're going to use the most recent annual report for these numbers. And the first thing we're going to go down to is the balance sheet to look at the long-term debt to equity ratio. And so what we're looking at is we're looking at long-term debt, and we're looking at it against stockholder equity. And we've got long-term debt right here at $30.193 billion, right, for the most recent fiscal year. And we're dividing that by stockholders' equity, which is right here, 29,875. So we've got a long-term debt to equity ratio at right about 1.01, which I note right here. And then we've got the interest coverage ratio. And again, as I've talked about in prior videos, I don't really place a lot of importance on the long-term debt to equity ratio because, frankly, shareholder equity, stockholder equity, that can be affected by numerous different factors. I just really don't. I mean, I list it on these articles and I talk about it in the videos because it's a bellwether metric that a lot of people like to look at. But if that number were 1.5 or 0.75. It wouldn't really make a big difference to me personally. The main number I look at is the interest coverage ratio because this tells us how many times over EBIT is covering its interest expenses, okay? So that would be the same thing as if you're looking at your own personal situation. Instead of kind of looking at net worth, which is what debt to equity ratio is basically, it's kind of like a company's net worth. You're instead looking at your ability to cover your interest expenses. So if you have your mortgage and your credit card debt and whatever else you have, you're just comparing that against the total income you're producing before that amount of money sent out to cover the interest expense, okay? In order to get that, we're looking at earnings before taxes and interest. We're looking at EBIT. And so the first place we're going to go to is income before taxes, which is right here. So it's income before income taxes right here. This isn't EBIT though, guys, because it's already factored out the interest expense. It's already taken off that. So we got to add that interest expense back in order to get EBIT for the interest coverage ratio. And the interest expense is right here. 1260, 1.2 billion, right? Whoop. So we've got total EBIT for Amgen at 10.423 billion, and then we're basically going to divide that. We're going to look at how many times over that covers this interest expense of 1.260 billion, which is 8.27 times over. And I note that right here, the interest coverage ratio is just over 8. That's a pretty good number. I'd say right here, they're solid numbers. I wouldn't call them excellent. The balance sheet isn't phenomenal or anything like that, but the balance sheet is okay. It's not in trouble. It's not tremendous or anything like that, but there's certainly so much more to like about the business to where you look at the balance sheet and say, yeah, it's okay. It's not great. It's not terrible. Just okay. I think when looking at the company, maybe it's not a strength, but there are so many other aspects that are, and one of them I'm about to get into right here is profitability. And these are some really eye-popping numbers here that we're looking at here. This is average net margin and return on equity over the last 5 years here, 20.74% and 24.30%. So we got net margin at almost 30%. That's incredible. And I've noted in prior videos and in my articles, I moved to Chiang Mai, Thailand for a number of different reasons, not all financial. There was some financial motivation there to come here because the purchasing power here for me is much greater due to the lower cost of living and the different cost structure. And the healthcare system here is significantly different than it is in the States. And what I mean by that is that the cost structure overall is much lower. So the cost of healthcare, the cost of going to a doctor, the cost of getting drugs and everything else, all of that stuff is totally different over here. And when we talk about some of the healthcare things going on in the United States, I mean, look, I'm a shareholder of Amgen, so these numbers are very impressive for me. I'm grinning from ear to ear when I look at this stuff, when I look at investing in Amgen. But at the same time, this is really incredible profitability, guys. You look at this number and say, wow, Amgen is not going broke anytime soon, okay? And in order to get that number, I'm basically just averaging out. You can see net margin right here. You see these numbers here, and you can see them actually improving. Look at where they were, in here, and look at where they're at over here. I mean, they're coming in solidly over the last few years, well over 30%. It almost kind of takes my breath away when I look at this stuff. And return on equity, you can see it down here too. I'm not going to average them out just because it takes a little bit of time, but you can see where I'm getting the numbers from here. These aren't made up off the top of my head or anything like that. These are really strong numbers. And if you ever want to pull up net margin for yourself, it's very easy to pull up. You're just taking net income against revenue. So we got net income 77.22 against revenue. So you can see right here net margin well over 30%, which is phenomenal numbers. And the reason I like net margin so much, return on equity, it's analogous to what I was talking about with long-term debt to equity. It's kind of the same thing. You're talking about return on business net worth essentially. Net margin though is basically saying, for every dollar in sales you have, how much of that, what percentage of that drops down to the bottom line? Of course, if you're selling $1 of goods, you'd much rather have 30 cents in profit than 5 cents of profit, right? Because it tells you you're a much more efficient business, that a much larger percentage of your sales is dropping down into profit. So the higher the net margin, all else equal, the better a business is. And that would generally indicate strong competitive advantages. It would indicate that there is strong demand for their products. It would indicate premium pricing power, brand power, and things like that. So on the flip side of the coin, you generally will see lower margins on like middlemen, wholesalers. The retail industry is often like that. Not always. Some retailers actually do have some really impressive margins, but more general retailers will have lower margins because they're more price takers and price setters. So just something to keep in mind. And when we're talking about Amgen, they're really not a price taker. They are a price setter. These are our drugs, and this is what they're going to run you, kind of a thing. So just incredible numbers here, profitability wise. And I get a little bit into the rest of the company, kind of qualitatively here about why I think they're going to continue to do quite well looking forward. And again, you can get it. If you want to go through Amgen and really break it down and spend hours looking at the portfolio and looking at the trials and everything they've got going on and where the R&D money is going, you can do that. But for the intents and purposes for these videos and these articles, I'm trying to keep the articles roughly around 2,500 words. I'm trying to keep the videos roughly about an hour to just kind of break things down and bring some of these ideas to you guys. And really getting back to my initial point on Occam's razor, I think you want to be careful and try not to overcomplicate things. Do I need to know every single iota of Amgen's business to make an investment and to be very successful and to collect growing dividends from the company? No. Do I need to have a pretty concrete understanding of how they make money, what they're doing, what kind of expectations I can start to build going forward, where I think the company and stock is worth and all this kind of stuff? Yes. And that's what we're trying to do here. So you don't want to overcomplicate your investment strategy. You don't want to overcomplicate your life, and you don't want to overcomplicate a stock analysis or a business analysis. You don't need to have a PhD in science or something like that to understand what these drugs are, what they do, and why they're necessary to humanity. Okay, guys. Getting into the valuation, though, the PE ratio right now is sitting at 15.36 when I wrote the article. It's potentially, it's obviously a little higher, just slightly higher than that, because the prices we saw earlier has increased a little bit because yield's a bit lower now than it was when I wrote the article. So we know that. So this PE ratio is a little bit higher, but not noteworthy enough to really get into it too much. But that's where it was when I wrote the article. But if we want to see where we get that from, of course, we're looking at trailing 12 months earnings, 1107. And we've got the current price. We're just basically going to take the current price and divide that by the 1107. Which is somewhere in 177, right? Yeah, 176.22 divided by 1107. So we've got a PE ratio right now as I do this video of 15.92. It was 15.36. It's moved up just a tad. It's not something I'd really go screaming from a mountaintop about, because when you're looking at investing in these businesses, guys, as I've spoke about before, actually with the video I was doing on James Smucker, I was kind of talking about this too. If a business jumps a little bit after these articles are published, it doesn't mean it's all of a sudden not a great long-term opportunity. And when we talk about the valuation, there's always an estimate there. It's not an exact number. So when I value the business, it could very well be worth slightly more, slightly less, or even moderately more, moderately less than where I come out. So, it really depends on where you think the company's at and what kind of margin of safety you're looking for. But, Amgen moving up by a few bucks a share, that is really not something to be super, super concerned about or something over the long run. If you thought, oh, Amgen looked attractive here when this article was published, now it looks like a terrible idea. That's not the case at all, or that's at least not how you should be thinking about it as an investor. So I just want to make a note here, though, that PE ratio 15, a little over 15, that roughly matches the company's growth rate over the last decade, which makes it a PEG, a price earnings growth ratio of 1. Which is, you don't really see that too often on a high quality stock in this market, where the market is arguably as expensive as it is. To get a PEG ratio of 1, I usually see a lot of times good businesses PEG ratios well over 2. To be getting near 1, even if their growth rate slows down quite a bit from here, and we say, as we talked about earlier, maybe comes in at somewhere closer to 10, that still would not make that PEG ratio notably high or particularly high, especially relative to what a lot of other stocks are looking at. And I just note here that's significantly lower than both the broader market and the industry average, and we'll get into that right now. I'll show you what that looks like. So we're going to click on the valuation tab at Morningstar. So you see the industry average PE ratio right here, and that's because, now to be fair, that in that basket you're going to find a lot of really small biotech companies that are way higher on the risk scale because they don't have maybe that track record there. So, I wouldn't put too much faith on this comparison here, where you're talking a PE ratio below 16 to something well over 60. But you can see the broader market right here at well over 20, and frankly, you see the 5-year average for Amgen right here at closer to 19. So there is a pretty nice discrepancy there between where Amgen is at right now, what investors are paying for its earnings now compared to what they've been paying over the last 5 years. And now there may be some logic behind that. If you're saying the business is going to slow down a little bit, at least over the near term, you could say, well, yeah, the valuation should be compressed a bit because of slowing growth rate, and that would be correct. But that's a pretty sizable drop there compared to where it has been, and Amgen really isn't that much different, a year or 2 or 3 ago compared to where it's at today. So that's a pretty sizable drop though. And as I noted earlier, of course, the yield is also significantly higher than where it's been over the last 5 years, keeping in mind the caveat that the dividend was 0 as recently as early 2011, but also cash flow. If we want to take one more stab out of here, price to cash flow 11 times, average over the last 3 years 14 times. So investors are paying less for the earnings, less for the cash flow, and they're getting more yield for their trouble. That adds up to a pretty picture to me. Getting into the dividend discount model analysis, of course, as we've gone into in every video and every article, with this one it's a 10% discount rate because the yield isn't particularly high. So we're going to start getting into that right now, and we've got the annual dividend at $1.15 not $1.05, right guys? Sorry about that. I don't know where I got that number from. So we got 460 on the dividend. And looking at the dividend growth rate, I pegged it at 7.5% over the long term, guys. Now, I actually think that is actually on the higher end of what I normally allow for, with 8% being the ceiling for long term. And I can go all the way down to 2 or 3% depending on what it is. If we're talking about like a utility or something, so it depends on what we're looking at. 7.5 is on the higher end of that spectrum on that particular scale. But I think relative to where Amgen's been at over the last 10 years in terms of its business, in terms of where the dividend's growing, in terms of the payout ratio, in terms of where we think they're going to move going forward, I really don't think that's all that aggressive. It's half what the company has done in terms of earnings growth over the last decade. It's half of what the last dividend increase was. And frankly, as I've said a few times now, I think the dividend growth, at least over the next few years, could be, very well near 10%. Of course, not forever, and it will flatten out at some point in time, but averaged out over the long run, I think 7.5% is probably a good number to start kind of considering. And again, building that foundation of where they've been at, and then starting to build that house based on where we think they're going, the payout ratio, what the most recent dividend increase was, what the earnings growth is like in the last 6 months or last year, where we think they're going to go moving forward. As you start to build put those bricks in, you start to kind of build a house. And you start to have a brighter picture of where you think the business is going to be at moving forward. And that's the house I came up with, guys. I think 7.5% is very reasonable. So building in that dividend discount model, of course, we got 7.5. It's not a two-stage. It's just one growth rate. And we got the dividend discount. We got the discount model at 10% because the yield isn't notably high. And we've got a fair value at 197.80. Which I note right here, the dividend discount model analysis gives me a fair value of 197.80. And I note why I use the dividend discount model analysis right here, which essentially is just a tailored version of the discount cash flow model, which is more or less the gold standard of valuing stocks. It's just tailored to dividend growth stocks. That's all it really is. And right here my valuation model shows a high quality dividend growth stock that appears to be considerably undervalued, but my perspective is, as always, limited to my own views, my own viewpoints in this world, and that house that I built was based on the bricks I put in. So when I put this number out there and I say I think Amgen's worth, roughly somewhere around 197.80, that's an estimate. It's not an exact number, but I think that's where it's at. Of course, that's just where I think it's at. So I think comparing my valuation to what professional analysts come up with adds value and depth for you readers. And I really believe in that. So the first one I compare my number to is Morningstar. It's the first firm. Morningstar is well known, of course. And the fair value estimate they come up with is 193. So just right kind of in the same neck of the woods as where I'm at. I came in just slightly higher, a few bucks, which is just kind of almost a rounding error at this point where we're getting up into this big a number. So they came up at 193. And CFRA, we're going to scroll down to their fair value calculation. They have it at 183.98, and CFRA has it at a 4-star buy. So I've got this noted right here. They rate Amgen as a 4-star buy with a fair value calculation 183.98, and Morningstar has it as a 3-star stock right here. So they rate their stocks at CFRA too. They rate them on a scale of 1 to 5 stars. With Morningstar, 3 stars meaning that they believe that stock is roughly fairly valued based on where the current price is and where the fair value is at. I think that this is probably right on the border of it being a 4-star stock. I bet if Amgen were to drop maybe a few more dollars or so, at least from where I wrote the article, it'd probably be a 4-star stock, but it's probably right in that range. And then CFRA basically just does the same thing, but they basically have 1 star would be a strong sell, 2 stars would be a sell, 3 stars would be a hold, 4 star would be a buy, 5 star would be a strong buy. So it's just it's almost the same thing though. We've got a fairly tight consensus that Amgen's worth, we're going to say over 180 a share for sure, and there's even some Morningstar and I came up with a number that's over 190, and I really believe that's probably the more accurate number, somewhere around that 190 or so mark. And if we average the 3 out, we'll do that right now, so I'll show you where I came up with that number. So we've got 193 for Morningstar, we've got 183.98 for CFRA, and we've got my number at 197.80. So they're all evenly weighted in this averaging. we come up with a number of 191.59, which is right here. And again, as I just said, I think that's a pretty reasonable estimate for Amgen's valuation. You know, somewhere around 190 a share, I think is a not just an accurate look at where the valuation is at, within reason, of course. These aren't exact numbers, but I think if you're talking about an estimate, that's a fairly accurate estimate. And I think it's also a conservative look, frankly. I mean, I think that my long-term look at the stock and talking about the dividend growth and the discount rate and everything else, I don't think there's anything really super overly aggressive there where you could say, whoa, that's kind of crazy. You know, I don't think the business is going to do that. There's nothing that would indicate that Amgen is going to slow down so materially that it's going to be well below that number when you flatten it out over the long run. I just don't believe so. And of course, when I wrote the article, that led us to a stock that was potentially 13% undervalued. If we want to do a new number on that based on where the stock is at today, we'll do that. So we've got the fair value estimate right here, 191.59, and we're going to compare that to where Amgen stock is right now as I film this video. And I don't think it's going to be a lot different. It might be a couple percent different or something like that, but not enough to where Amgen would be any less of a long-term opportunity all in all. I don't think. So we'll see where that's at. Okay, we've got the stock at 176.22. So we're coming in closer to 9%. So it's not quite as attractive as it was when I wrote the article. Of course, these videos aren't designed to be timely like this. The articles are only meant to break down the article and show you where everything came from. The articles are designed to actually be the idea presented and kind of the opportunity to take a look at a stock Monday morning, because these articles are published Sunday. So it gives you the opportunity to maybe take a look at it over the weekend and maybe be ready to pull the trigger or invest in that stock Monday if you so choose. The videos are not designed to be like that. These videos are designed to just add value and perspective to the articles and add depth and everything else. But, you know, going from 13% to, 9% or so, that's really not that much of a change. I don't think that you're gonna that's gonna make a big difference in terms of where you're looking at it with this stock. So it's a high quality business here. We're gonna get into the bottom line right now. Bottom line, Amgen is a high quality firm that's extremely well positioned to capture plenty of growth from simple and long-term global trends. An incredible track record for growing its profit and dividend looks set to continue for many years to come. Meanwhile, the stock appears 13% undervalued as the article was published, offers a yield near 3% on a well-funded dividend, and has demonstrated double-digit dividend growth. Dividend growth investors would do well to strongly consider the stock for long-term investment. And also, Daily Trade Alert adds in the dividend safety score from Simply Safe Dividends. So this basically is a score that ranks from 0 to 100 in terms of how safe a company's dividend is. And Amgen, as this article went to press, the dividend safety score was 93, which is almost as good as it can get, right, guys? I mean, 100 would be perfect, which I don't know if any. I don't know the whole. I don't know all the scores for this, so I don't know if any stock scores 100. But 93 it basically is about as safe as it's going to get for a dividend. So if you're looking for a safe dividend, a dividend near 3%, expectations of dividend growth over the near term to be somewhere near high single digits, low double digits, somewhere maybe 9-10% or somewhere in that range. Looking out over the long run, certainly well into the single digits, the high single digits, and well in excess of inflation. And you're looking at capturing very simple, easy to understand, and highly likely to transpire global trends. And we talk about the world getting older, richer, larger. These trends are not stopping. They're not slowing down. They're just going to continue. And so the demand for these, for the products, high quality healthcare products like the products that Amgen produces and markets and sells, that demand is not gonna go away. People are gonna want to live longer. They're gonna want to have access to higher quality healthcare, and as they have more money, that's gonna manifest itself into greater sales and greater profit for a company like Amgen. And we see those net margins. We see that that is not changing. That is only if anything, it's gotten better over the last few years. So the company is doing extremely well, and that bodes well for the dividend. That bodes well for dividend growth investors looking out over the long run. And there's just really not a lot to dislike here, guys. The only thing to maybe dislike a little bit as I publish this video is that the stock's slightly less undervalued than it was, with 13% being just, modest undervaluation, obviously. I mean, that's not significant. It's not 20, 30, 40% or anything, as you would not expect for a company like Amgen in this market. But I still think there's a ton to like here, and it's a wonderful business, very secure dividend that's highly likely to grow for many, many years to come. So to me, it looks like a great opportunity, and I'm actually considering adding to my position here over the near term. So it was a wonderful video for me to produce for you guys. I have a lot of fun doing these. I write a lot of articles every month on this stuff. It's a pleasure for me. I'm truly humbled and honored to be able to do the articles, to be able to do the videos, to hopefully help you investors, motivate you, inspire you to reach for your, make your dreams come true and become more financially secure in your life and potentially financially independent. It's an honor for me to be able to do that. So I appreciate your time today, guys. I hope you enjoyed the video. I hope you enjoyed the article. We should be able to do another video this month as well. Hopefully have that published out, maybe in a couple weeks or so. But again, it's a pleasure as always. Thank you so much for your time today, guys. We'll see you next time. Bye-bye.